This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we're joined by Patricio Alvarez in London, and we've got, for the first time, our associate Alessio Mastrandrea joining from Princeton today, though normally he sits just there to the left of Patricio. Our colleagues Will Harris and Sally Ilmaz are off doing client meetings in China this week. So if you're in China and you want to meet with them, make sure to shoot them an IB. They might be able to see you. I can't remember what city they're in at the moment, but I know it included Beijing and Shanghai and Hong Kong. So they're doing a bit of the tour. Fernando Valle, normally on the call as well, is off on some much needed vacation. So the full band will be back together next time, I believe. But this is the crew for today. So just doing a quick check-in on commodity prices. If you haven't been watching the screen, Brent oil has been on a bit of a tear, just crossed over $95 a barrel for the first time this year. I believe yesterday, natural gas in Europe, we're back over 30 euros a megawatt hour. If you don't think in euros per megawatt hour, we're talking about just under $12 per MMBTU. If you're a Henry Hub person, you're thinking sub $3 per MMBTU at the moment. So big differential there. If you look in the broader commodity complex, polysilicon, key input for the solar industry, it continues to trade sideways, and it's down about 75% over the last 12 months. We've also seen module prices for solar modules coming down about 40% over the last 12 months. So we've really got a tale of commodities. They're not all moving in tandem at the moment. And so let's come to you first, Patricio. How is European natural gas looking? Where are storage levels at? What are we in crisis mode right now?
Yeah, I think I'll take the last part of your question first. Yeah, I don't think we are in any sort of crisis at the moment. If anything, I think in the near term, elevated storage levels here in Europe, which are trending just above 94%, which is the second highest only versus last year. That shows you that the region has a quite a big buffer, and suggests that potentially the short-term supply disruptions we're seeing from extended maintenance in Norway, and from the strike action in Australian LNG in the Australian LNG plants may be overstated in the price reaction, just given that we have this significant storage buffer in the near term. On the demand side, we've seen very little signs of recovery versus last year's decrease, with consumption, especially in industry, remaining roughly 20% below the long-term average. And that's despite the summer, the expected pickup during the summer. And on the weather front, weather has continued to be relatively normal, which means there is no upside versus last year. So all in all, we do expect sort of we don't expect any sort of supply disruptions during the next winter. And if anything, storage gives us a good indication that prices may start easing into next year.
Alessio, I want to come over to you. Let's do a quick check-in on solar industry. What do you make of the fact that demand is growing super fast? Our colleagues at Bloomberg NEF are projecting global installations will grow more than 50% this year, but yet we seem to be watching polysilicon modules come down. What's the story there?
Yeah, it's a bit crazy because even if you look at, let's say, EV to EBITDA on a 12-month forward basis, that's come down to under 9x, whereas a year ago was trading at, I think, 15x. And if you want, for comparison, you've got the S&P 500 trading at about 12x, the World Index trading at 11. So it is a funny story where, we're seeing slight margin improvement despite kind of all these prices coming down. It's kind of like a weird mix of the tidal wave where you're seeing, one input go up and one output go down. But when I guess you kind of think about it, like a good proxy would be Canadian Solar. They're going to increase revenue by about, or no, sorry, deliveries by about 50% this year, but they just lowered their guidance to about 9 million. Luckily, they're still going to be able to keep their margins at about 18% versus about 16 last year. So I think we're seeing slight margin improvement, but just not as much as maybe we thought at the beginning of the year.
Yeah, very very interesting. I think the solar players, in some sense, demand's growing fast, but so is supply, and so we've got this very interesting world. I think it's a little bit different in some of the sort of old school energy commodities, bit more balanced, tighter supply demand balance, whether you're looking at oil or gas in Europe. Now, one of the things that really plays into this sort of broader ecosystem to connect all the dots would just be, there's trade-offs between renewables and gas in particular. And long running idea has been that gas is a transition fuel. Some people would say gas and renewables are frenemies. They sort of dovetail with each other, but they're also competing. Now, on this front, Patricio, while you were off having a lovely wedding in Ecuador, one of your companies, Orsted, had a sort of very significant mishap. On our call last week, we did our best to sort of give some homage to your react and work on it, but what happened with Orsted, and what's going on in the offshore market? Did gas and other factors even playing into what the kind of problems that they're seeing?
Sure. I think one way to start would be to dissect what occurred to Orsted back on the 30th of August. So the company announced or pre-announced potential impairments of up to 2.1 billion euros or roughly 16 billion kroner on their U.S. portfolio. And that impact concentrates around select projects. That's a handful of projects that are nearing their final investment decision later this year or early in 2024. So the company needs to sort of mark the value of its investments to market prior to reaching the final investment decision. And there are three reasons for the impairment, and the three of them are sort of have an equal weighting on that 16 billion kroner value. So first of all is the increase in interest rates, which is affecting mainly all of the net present value of renewables, really, and that sort of explains the broader sell-off in the market as well. That's impacting solar and other wind producers as well. On the other hand, you have supply chain related delays, which mean that the development costs have gone up in real terms. And finally, the last part of the puzzle is that there's a bit of uncertainty, or really there is uncertainty on how much Orsted is going to get in terms of the investment tax credits it was applying for on a handful of projects. And they are applying for the upper range of the investment tax credits, which is 40%. So far, they've managed to get 30%, and sort of meeting that extra 10% will rely on them meeting some local manufacturing requirements or local energy community requirements. So the company is trying to find ways with the regulator to sort of progress into achieving these higher investment tax credits. We pretty much think that the other two reasons are impacting the sector as a whole, and we see really high potential for those impairments to materialize. So we're talking about 10 billion out of the 16 billion, and the other 6, there might be upside through the end of the year, depending on how regulators react to these impairments, which could be a harbinger. I think if the U.S. has these really strong or really ambitious targets to reach installed capacity of 30 gigawatts by 2030, and from virtually zero at the moment, I think there will be there'll be pressure on the political front to progress these projects however way possible.
Very interesting dynamics. By the way, for everyone who's on this call, if you don't know BI, we've got about 400 analysts in-house, including a very talented tax analyst. His name's Andrew Silverman. He's based in New York, and he really knows the nuance of all this tax discussion around IRA really well. We have made a mistake by not having him join this call up to this date, so we'll get him on soon so he can share with you some of that nuance, because I've been on numerous client calls with him, and he does know what's going on there. So if you need an introduction to Andrew and you kind of want to understand the tax landscape beyond the IRA, frankly, he's a great resource here. But Alessio, I want to come over to you and get a sense, based on what Patricio just said, how important is the offshore build out to the wind equipment manufacturers? Is this a big deal, the kind of thing that we're seeing happen here with Orsted?
Well, I think it could be. When you think about offshore builds, you have to keep in mind that the lead time is about 7 to 10 years. So as far as revenue recognition goes, at least for the OEMs, we're talking 2030 and beyond. I think the story right now is still onshore. So if you look at, our peers, Vestas, Goldwind, and Nordex, they all increased their deliveries by about 20 to 40% in Q2. Order intake grew quite fast. Goldwind added 3 gigawatts in 2023. Vestas added 2.5 just in Q2, and Nordex is up about 10% to 1.8. All these companies have backlogs of 20, 30 gigawatts, and most of that is composed of onshore. Building onto this onshore kind of focal point, we do have a focus idea on Vestas, and we're seeing strong demand, margin improvement, driven by lower steel prices, which are down about 20% this year. And then we could see EBITDA increase to about $2.5 billion in 2024. That's about a 25% upside to consensus, and pretty big jump from last year, where they actually recorded a loss for the first time in a few years.
Can I probe a little further? Patricio brought up the idea of interest rates affecting the business. I think particularly when you look at the solar residential side, we have seen some headwind and friction there because of the interest rate environment. What's your sense? I mean, how big of a deal are the higher rates for wind versus solar? Is it more meaningful for one versus the other?
I think one of the bigger problems for wind is likely a lot of the bureaucracy and red tape with kind of the new projects. With solar companies like SunPower, we are seeing kind of ripple effects with the interest rates. We saw guidance get cut for a lot of these manufacturers. The only names that were really protected were companies like First Solar, where they are buoyed by the Inflation Reduction Act, and they're just expanding like crazy. They just built their 5th factory in the US. They're one of the largest solar manufacturers in the Western Hemisphere.
Patricio, I want to come back around to you and noodle a little bit more on kind of interest rate and kind of how it's affecting the project landscape. I mean, Alessio mentioned the idea that an offshore project is a 7 to 10 year endeavor. I think you can do onshore quite a bit faster, maybe kind of 3 to 5 year range, maybe even a little faster if you really on all cylinders. And solar, a much shorter lead time. So, if you're optimizing a multi-decade portfolio, how much are you really looking at interest rates right now?
So that's a good question, tricky question, I guess. It depends on how long you expect interest rates to remain this high. I think that will be a main driver for your capital allocation. Just as a side note, Orsted CEO acknowledged during the earnings call that followed the impairment warning. He mentioned that a 50 basis point change in debt. In debt cost or in long-term yields shifts the value of the U.S. portfolio by about 5 billion kroner. So that just gives you the indication of how much interest rates matter. In terms of how you would balance out your power portfolio looking forward, I think offshore wind is it's the most exposed because of the combination not only of interest rates. So as Alessio mentioned, it has longer lead times than other technologies. So that means that also means that there's a higher component of upfront capital that you're putting in at risk, and it means a longer payback period. So interest rate increases are going to impact that technology harder than others. And on top of that, you also have a more nascent supply chain. So these local manufacturing mandates mean that that you cannot simply just you turn up and start building immense wind blades, and there is no vessel capacity. There's no ports to afford this. Like, these need to be built out, and I think perhaps the industry is going through sort of sort of a rude awakening, or like sort of teething problems on the side of the regulators to acknowledge that these supply chains don't exist yet, and building them out will take longer than expected. And obviously that needs to be recognized in the auction prices, in the strike prices, by affording higher strike prices, or maybe flexible sort of pricing mechanisms that let the developers sort of recover the cost over time.
On the idea of development, one of the big topics is permitting, particularly for wind. And onshore, you've got this natural constituency. Maybe farmers or other people say, I don't want to look at the wind turbine, or it's you've got stakeholders that really will often push back on a particular project. Offshore, I think you avoid that typically, though maybe that's not the case. So how are things looking on the permitting front? Is it mostly about getting the auction prices right, or are we still seeing a lot of red tape on the permitting side for offshore?
So that's a definitely yes. So Orsted broke ground on Ocean Wind in recently last week, and even though the development, they're just starting to develop the sort of the onshore part of the offshore installations, that was already faced with community opposition from folks sort of stating similar claims to what you're saying, Rob. They just don't want to look at it. There's also sort of an environmental component. There's just advocates of climate advocates saying, or sort of environmentalists that claim that it may affect even how birds or birds nest, or it may affect fishing resources as well. So I think in theory, like what you were saying, is what the incumbent view was prior to sort of the start of the build out in the U.S. The view was that onshore development was likely to face more opposition because it's really in people's backyards, if you will. And on the other hand, I think offshore wind it still holds value in the future of the energy mix, just because it is, higher capital intensity. It does, I think, entail less sort of community opposition than onshore, just because of the nature of where it is, and that might, get some that may get some easing of or getting used to, I guess, in time. And finally, offshore wind, the load factors for offshore wind are nearly double those of onshore wind. So although it seems like these current headwinds may extend for the next couple of years, meaning that the capacity targets for 2030 may be at risk, our house view is that there's still going to be plenty of offshore wind being built, and companies like Orsted and others will be there, sort of in the prime position to build out whatever needs to be built.
You brought me back to a different period in my life. I remember in the 2000s, when I was living in Massachusetts. Anytime I'd go to Cape Cod, you sit on the beach there, and there'd be people going by with clipboards trying to build signature opposition to the Cape Wind project at the time. And they would show you pictures of what it was going to look like. It was just going to be a little dot on the sort of horizon there. And there was a group of stakeholders, even for that offshore project at the time, who were trying to rally the troops to oppose the project. So, all of energy involves trade-offs. And I guess no matter what kind of energy you're doing, there's going to be some set of group or stakeholders that oppose what you're up to. So Alessio, I want to come back to you and get you to weigh in a little bit on the offshore onshore question a little bit more. Now, from the perspective of the OEMs, uh, you know, is offshore really gonna be the key to the future? You know, how you already mentioned that onshore was really where we're seeing most of the activity in the order book, but I kind of want to understand a few things. One is, you know, Siemens Energy had relatively big problems on the quality lately, and you know they've had some write downs related to um, repairs, unanticipated maintenance that they've got to do. You know, is this a a big problem for the industry? Is there read across to the other players? And how do you think onshore versus offshore on the sort of technology build out perspective? And then one other piece I want you to hit too. Is there a geographic component to where offshore is happening?
So thankfully, the problems we've seen at Siemens Energy's Gamesa unit haven't necessarily had read across for Vestas and our other turbine manufacturers, even though a lot of the suppliers are the same. Vestas was saying that they do take quality control very seriously. While they can't speak for how Siemens Energy does it, they don't foresee that kind of being an issue. As far as onshore versus offshore, so our colleagues at BNFC, annual new builds to be about 126 gigawatts by 2030 for onshore, and for for offshore, it's going to be about 43. So I think in the medium term, onshore is still going to be a big piece of the puzzle. I just think the kind of lift off for offshore is going to be, more towards the end of the decade into the 2030s and through 2040. And yeah, so hopefully that mix can kind of help bring wind to the same growth rates that we're seeing in solar.
You know, one of the really interesting ideas there is that if you look at IEA's net zero scenario or some of the net zero scenario work that our colleagues at BNEF have done, you know, wind needs to grow quite a bit faster or more over the next 5 to 10 years than solar. So, you know, ballpark range, you know, the IEA, I think in 2030 has annual wind installations at 400 gigawatts a year in their net zero scenario. And, you know, this year we're probably going to do 100, 110 gigawatts, somewhere in that range. So you're talking 4-ish X growth.
Mm-hmm.
Now, on the solar side of the equation, I think IEA's net zero scenario is 600 gigawatts of additions per year by 2030. Given where we are today and the kind of growth rates we're seeing, that seems quite achievable. And I don't think it's unreasonable to be even talking about a terawatt or 1,000 gigawatts a year of solar at this point. So, Patricio, I want to come back over to you and just get your sense on this idea of, well, if offshore wind is disappointing a little bit right now, how are companies managing their capex? Are they diverting or placing more emphasis on solar? Is gas even still investable? Is gas a piece of it? Maybe nuclear? What's the sort of generation portfolio mix looking like if you kind of take a 5-10 year look out in the future?
Right. So yeah, that's a great question. I think I'll start. For offshore wind, obviously, sector headwinds. We don't expect them to subside significantly for the next couple of years. So probably through mid-decade until things start to relent or to ease a bit there, especially from interest rates. I think utilities, well, depending on which sector of the value chain you are. So if you're an integrated utility, we've seen capital allocation veer towards network investment. So there's still a massive investment opportunity in modernizing and transforming the electricity grids here in Europe and in the US, arguably, to connect all these new renewable capacity, albeit being from solar or wind, that's indifferent, or whichever technology utilities can invest in the energy transition that way. And we've been seeing that in the likes of Iberdrola and Enel as well, just investing a bit more in regulated assets, which tend to be protected versus inflation. And they also allow you to recover borrowing costs. So that makes sense from that standpoint. In terms of solar is like you said, the lowest hanging fruit in terms of deploying new forms of generating electrons. But solar is also cannibalizing prices in certain markets, and that would concern me if I was a utility, depending on what portfolio I have in terms of revenue. That would probably mean that utilities will seek to achieve better and more corporate PPAs and sort of try and hedge their position in the market a bit in the longer run. In terms of gas, I think gas is still a valid sort of source of technology and power, although BNEF and I think most analysts by now see the sort of the share of gas in the power mix declining through the end of this decade and starting next year significantly. Yeah, I think because there's battery storage is still not in a state, or is not economically feasible yet to build out and scale in Europe at least, and the US perhaps as well. Gas is still, it pollutes half as much as coal, and is a flexible source of power generation, quick to dispatch. So I would definitely not discard gas as playing a significant role in the power mix here in Europe, especially since applications from green hydrogen are not have not yet achieved scale or commerciality at this stage. And finally, nuclear will depend on which region of the globe you are. I think China is by far the only place where nuclear is being invested in seriously and may actually yield capacity additions over the next 5 to 10 years. Here in Europe, nuclear is very much in a hiatus. I think EDF, being the largest nuclear power producer in the world, is trying to just sort of keep its fleet afloat and trying to improve or recover volumes from last year's outages, which were related really to safety and really just reflect the aging nature of the fleet. And I think it's similar, it's sort of a similar outlook in the US, where it seems that if you wanted to invest heavily in nuclear, it was something that governments should have started doing perhaps a couple decades ago. And given the lead times and the cost of capital, it's really hard for private investments to grow into nuclear.
Absolutely. If you think about the idea that interest rates are affecting renewable projects, affects nuclear as well, very capital intensive set of materials involved. But nuclear is probably one of the leading candidates when you think about a net zero world for contributing, right? It's very hard to get all the way to this idea of net zero that some policymakers and other people talk about without having a nuclear, a hydrogen, a CCS, all these kinds of other things in the mix. And so very interesting to keep an eye on the nuclear space to see if small modular reactors or some of this other technology can really transform that landscape. But as for now, I think you hit the nail on the head. Alessio, I want to come over to you just quickly before we wrap up on the idea of solar plus storage based on what we just heard from Patricio. It's quite evident that if you're looking at some of the wholesale power markets, I mean, solar has done some radical things to those markets where you get kind of low or even negative prices in the middle of the afternoon, which used to be the sort of peak period for wholesale power pricing. And now the peak is occurring in the early evening after the sort of sun starting to go down. So you're seeing all these like interesting dynamics. And because of that, I think we're seeing policymakers start to push a little higher on storage, particularly in California. So what's your read on how the OEMs on the solar side are kind of integrating the storage piece with their offering?
Yeah, a lot of the companies really started to kind of deliver their battery storage units in about 2021, and we saw a bit of a ramp up last year. This year, with kind of oversupply, and so for instance, Solar Edge has a battery unit, but they're not able to match the number of inverters they sell for the number of battery demand. So battery demand is really high, especially in Europe. And taking it back to the US with some policy stuff, California recently shifted from NEM 2.0 to NEM 3.0. Basically, that just kind of dictates how much you get back for when you sell your excess energy to the grid. And they lowered it if you do not have storage. But if you do have battery storage and it's coupled with, your solar unit, you get similar kind of credits for when you do sell back to the grid if you do have these batteries. So I think mid-decade is when we're really going to see batteries explode. Of the 3 companies under our coverage, Canadian Solar, Solar Edge, and Enphase, they're going to reach about 10 gigawatt hours of cumulative shipments this year, but it can go about 15 by the end of next year.
Yeah, it's very fascinating to note that Canadian Solar actually talks about roughly a 50 gigawatt hour backlog off the top of my head, maybe a little more than that. And so there's this sense that there's this big wave of potential there, but it's getting the delivery and execution going for some of the battery stuff as it scales up. Now, I think this is probably a great stopping point. I just want to come back to both of you real quickly and maybe sort of ask a framing question that we probably should have started with. Is just, okay, so we're talking particularly offshore wind on this call. And I'd love to get your sense, and we'll come to you first, Patricio. What's the biggest hurdle in your view to delivering on a vision for offshore wind? Is it simply interest rates? Is it permitting? Is it technology? Like, do the companies need to be putting more to R&D to get a better set of technology mix in place? Is it the vessels, building out more of that? And maybe the answer is all of the above, but what's your sense? What's really the key set of signposts that our clients can be looking for if they're watching this space and thinking about sort of a successful outcome in the offshore wind business?
So yeah, I'll try not to say all of the above, but I think the problem has, if you think about what caused the imbalance, right? Because awards moving into FID were signed at a fixed price that was much lower, right before the run up in costs and in cost of capital and debt. So the idea is that because the lead time from which you signed the award was maybe 3 to 4 years ago, meaning that the permitting is taking 3 to 4 years alone before you even start building anything. I think fixing that will at least reduce the risk of these sort of valuation imbalances occurring, and it will increase the visibility for investors and will keep the cost of capital much more up to date and sort of the risk reward profile in a better place. So I think permitting would be a great sort of way of fixing this from fixing or preventing this from happening again.
Same question over to you, Alessio.
So I'd echo what Patricio says. I think that's the biggest thing. But another thing to keep in mind is probably just not scaling too quickly. Earlier we briefly touched on component failures at Siemens Gamesa, and that was related to their new turbines. They were maybe kind of got to production too quickly, and that's probably a good lesson for a Vestas, a Nordex, a GE, a Goldwind to scale accordingly, keep quality control up. That way, if these permitting issues kind of clear up, they can go off to the races without any sort of snags that we saw with Siemens.
Very interesting. For anyone who hasn't observed the All In podcast, they just had their summit, and there was a very interesting talk from a guy named Bill Gurley that it's just great, and it's about government and regulatory capture and the interplay between the tech world and government. I highly recommend checking that out. It's about a 20-minute kind of TED type speech, and it might give you some ideas on kind of how you think about this space, because clearly the government is involved, but also you got private industry. So how's it going to all fit together? I think is a really interesting question, and it's going to be fascinating to see how the next kind of 5-10 years unfold, right? Because when you're talking 5, 10, 15-year project life cycle, I mean, this is this is well outside the normal range of a lot of companies, and so a lot's got to go right for it to succeed. I think the same thing is true of nuclear and some of the other tech in the power industry. So let's see how it evolves. On our next call, I think we're going to have Will Hare, Sally Yemez, Fernando Valley back joining us. Alessio, we're going to get you on again soon. Very good job on your first bi-monthly call here with us. And for anyone who has any follow-up questions, we're all in the terminal. We're all green dots right now. Shoot us an IB, send us an email. We're happy to follow up on any of the material that we've discussed, or help answer just any general energy related questions that you might have. Even if you want to talk with someone about tax or trade, we've got analysts who really specialize in that kind of stuff. So reach out. We'll get you in touch with the right person. I hope you have a great week, and I look forward to talking to you on the first Wednesday of October. Take care, everyone.